Today, we're going to talk about timing the market. This is a concept we talk about a lot with clients, and it's one of those things that it's easier to see it visually represented than it is to just, hear about it or read about it in words. So we're recording this in September of 2025, and it's easy to forget how this year has gone so far. So we just are going to take a look at two charts from the Ritholtz Wealth Management crew. They shared these out in a recent newsletter, which we'll link up to. The first chart we're going to look at shows what your returns would look like if you missed the first day off the bottom this year. So if you remember back in the spring, in late March, early April, around the tariff announcements, there were some pretty sharp drops in the market. And then there was a pretty sharp move off of the bottom, which we're looking at here in this chart. So this is what if you panic sold and missed the first day off the bottom, which in this case was April 9th. The difference is just under 10%. So the chart looks at, going into the year, and then from the bottom, the light blue line is if you just stayed fully invested the entire time, and the dark blue line is if you missed just that first day, just April 9th. And this is using the S&P 500 as an example. So your individual portfolio and return numbers will obviously look different than that, depending on how you're invested. But the move that day was so sharp off the bottom that the likelihood of being out of the market and then jumping back in on that day, on that afternoon, depending on what time you did that, your returns may vary. So, the likelihood of that happening is extremely low. It's another thing that we often say is that the best and worst days in the markets are usually, they happen in the same time periods. They happen one after another. And this year in 2025, we lived through that reality, and we can see how big of an impact just missing one day has on returns moving forward. Okay, so maybe you're saying, well, moves off the bottom don't usually happen that way. This time was different. This was a unique move because of, the tariff announcement, the pause that was announced. It usually doesn't happen in a V like this. So we're going to look at the next chart, which shows the average 12 months before and after market bottoms going back to 1950. There were 11 of these instances, or 11 bear markets or 20% drops going back to 1950. So the light blue line is the average of those 11 drops. The dark blue line is how it played out in 2025. So as you can see, the V-shaped recovery here in 2025 is not too far off from how it usually plays out. The moves off the bottom are sharp more times than not. To pull a nugget from the newsletter, this is quoting Callie Cox, who works as the chief economist at Ritholtz. The first month after the last 10 market bottoms has accounted for an average of 21% of the entire ensuing bear market. If you miss the first month after the bottom, you've missed 1/5 of the entire move. 1/5 just by missing the first month. So these moves happen, they happen quickly. Don't bring these numbers up to, take any sort of victory lap or to, say that, there's one way to invest. There's a million different ways to invest, but it's really difficult to time the market successfully once, let alone on a repeatable basis. We often share numbers from SPIVA, who studies how active managers compare versus their benchmarks. So over the last year ending June 30th of 2025, 73% of active managers underperformed their benchmark. So about 3/4 of active managers, these are professional money managers, underperform their benchmark. In this case, it's large cap managers, and the S&P 500 is their benchmark. So 3/4 of professionals underperform. Over 5 years, that number is 85%, 87% underperform. For 15 years, 88% underperform. And these are professionals again. So whether that's due to timing decisions or what they own or how much of what they own, it's really hard to beat the benchmarks year after year. We found that people trying to time the market often comes from a mismatch of time horizons. And what I mean by that is people put short-term dollars at risk in longer-term instruments or investments like stocks. That's why we believe so strongly in matching assets and liabilities, and we, construct our portfolios to do that. We have to make sure that the whole balance sheet makes sense before recommending an allocation. So that means, having enough cash at the bank, taking, an appropriate amount of risk between stocks and bonds. The allocations we do recommend are, built to withstand moves in the market where we have years of needs or years of liabilities in shorter term fixed income type instruments. So it doesn't have to, it's not exposed to the fluctuations of the stock market. Just two visual representations here of how difficult it is to time the market and the perils of trying to do so.